What if I told you the push to build endless fields of data centers isn't what it looks like on the surface?
Mm,
It's not just a technological race for supremacy. It's actually a massive debt-fueled gamble.
right.
And that gamble relies on a critical cash infusion from the one country the U.S. is desperately trying to contain. Before we go further, make sure to hit subscribe and support Geo9.
It sounds fundamentally counterintuitive, doesn't it?
Yeah,
I mean, we hear constantly about the US-China AI war, this battle for technological dominance driven by advanced silicon.
exactly.
But our mission today, diving into this, is to move beyond the chips themselves. We need to look at the massive financial, infrastructural, and geopolitical realities that are causing some serious strain.
Yes, this is your shortcut to understanding the high stakes here. We are stepping past the hype of what AI could be, and we're focusing on the credit markets, the, surprising failures in corporate AI, and the physical constraints like power and water.
Constraints that could make this whole build-out unsustainable.
And what we are seeing is financial pressure so immense that it's causing a rapid policy reversal in Washington, driven by pure necessity. And you should care, because if this AI bubble pops, the entire U.S. economy feels the fallout.
Okay, so let's unpack this debt gamble first, because the scale of the capital here, it's what really changes this from a technology story into a financial one.
It really is.
We're talking about the nearly impossible task of trying to build endless global fields of data centers all at once. Big tech is borrowing money at a rate that it dwarfs anything we've seen before.
The required capital expenditure, the capex, is simply staggering. When we look at bond issuance for big tech, so the money they borrow from the markets,
Yeah.
the projection for 2025 alone is nearly $240 billion.
Wow. 240 billion.
That figure is double what they borrowed last year, and it's even higher than the peak borrowing we saw during the post-pandemic rebuilding phase.
So it signals a kind of desperation for capital.
A desperate, immediate need. And if you project that forward just a few years, the number becomes almost difficult to grasp. So what are we looking at?
By 2028, tech firms are expected to borrow over $1.5 trillion.
1.5 trillion.
And to be absolutely clear, that figure is just for the AI data center CapEx buildout. That alone.
And existing U.S. trade policy is actually making this worse, right? More expensive.
Exactly. Because of tariffs, everything needed for these massive structures, from the copper wiring to the steel frames, can cost 20% to 30% more. So you need more money, faster, just to get the basic structure built.
This is where it gets complicated. JP Morgan used a phrase that stood out to me. A flood of data center financing could cause supply indigestion in dollars. What does that actually mean?
It means the market is getting overwhelmed. When one sector, in this case big tech, borrows such an enormous amount so quickly, it can overwhelm the market's ability to absorb that debt.
Okay.
This leads directly to what analysts call the two-body problem.
And the two-body problem is the core vulnerability here.
That's right, two interacting parts. On one hand, big tech is acting like a giant vacuum, just sucking up world capital and creating what many worry is a very unstable bubble.
And on the other hand,
On the other, what we call real industries, or Main Street, the U.S. manufacturing-based traditional businesses, they're being starved of capital. They just can't compete.
so the system is cannibalizing the non-tech economy that it fundamentally relies on.
Precisely. They're completely interdependent. I mean, think about it. Big tech relies on ever-increasing revenue to service that massive debt, that $1.5 trillion.
Of course.
But if Main Street loses jobs, if manufacturing contracts, and people stop buying things, where does that revenue come from? The borrowing itself starves the very economy that's supposed to pay the bills. It's a deeply unstable loop.
The narrative we hear from industry leaders, people like Jensen Huang of Nvidia, is just so optimistic. He says, we're well in the beginning of the build-out of intelligence. It sounds like a sure thing.
That's the hype. But what about the reality? What happens when companies actually try to implement this revolutionary tech?
This is where the rubber meets the road.
Absolutely. And this is the reality check Wall Street is starting to face. We have hard data, a study from MIT on generative AI and corporate projects, and the results are, well, they're difficult to believe.
How so?
95% of those efforts were categorized as wasted effort or outright failures.
Right, 95%.
95, only a mere 5% saw some measurable return or success.
That number is just shocking. But couldn't that just be, the natural teething process for new tech? Maybe only the riskiest projects failed?
It's a fair question. But the sheer breadth of that failure rate across multiple industries, multiple project types, it suggests a deeper flaw in the promise of immediate ROI.
I see.
If you're borrowing billions expecting a rapid transformation and 95% of your projects deliver nothing, you've fundamentally mispriced your risk. It challenges the sustainability of those debt commitments.
And if the return on investment is that low, the debt becomes toxic very, very fast.
Yeah.
Investors see this, and they know poor returns mean less business for the hyperscalers. Just to clarify for everyone, when we say hyperscalers, we mean the massive cloud providers, Microsoft, Google, Amazon, Oracle.
Exactly. If the corporations paying the bills aren't getting results, they stop paying the hyperscalers for compute time. And investors are already anticipating this. Traders are actively betting against major players right now.
Can you give us a concrete example of that?
Look at Oracle. They're a key hyperscaler taking on massive debt for this AI buildout. Right now, traders are entering the credit default swap market for Oracle with $4.2 billion worth of bets.
And a credit default swap, a CDS, is basically just an insurance policy against a company defaulting on its debt.
That's it. So traders are explicitly betting to the tune of billions that Oracle will default on the debt it took on for its AI expansion. If AI revenues were guaranteed, those bets wouldn't exist at this scale.
That is a huge red flag from the market. And it ripples out to everyone, right? Not just big tech. If this perspective feels useful, take a second to subscribe to Geo9. It genuinely pushes me to keep bringing more research stories.
It does. Experts anticipate credit spreads will widen from around 75 basis points to over 100.
So what does that mean in plain English?
It means the price of money gets much more expensive for Main Street. They'll have to pay much higher interest rates to borrow money compared to what the U.S. Treasury pays.
We have absolutely seen this movie before. It sounds a lot like 2008 when the credit markets just froze up.
It is structurally similar in one really dangerous way. Capital deprivation based on fear. Back in '08, the Treasury could borrow cheaply at, say, 2.4%, but standard BBB rated companies, they were borrowing at over 10%. That's a quadruple borrowing rate. We're setting up a scenario where government borrowing and big tech's trillion-dollar demand could just freeze growth across the rest of the economy.
So we've got a massive debt problem, a return on investment problem. But the cost escalation doesn't stop there. We have to talk about the physical constraints, power, and critically, water.
This is the overlooked infrastructure problem. Everyone focuses on the silicon, but operating these server farms requires colossal amounts of energy and, crucially, vast volumes of water for cooling.
The heat these chips generate must be immense.
It is. And we often locate these data centers far from cities to, escape taxes or be near energy sources, but we completely ignore the most basic needs: power grid capacity and sustainable water sources.
And the data on where these centers are located is, well, it's pretty shocking.
It really is. Over 70% of U.S. data centers are located in areas that are already experiencing significant water stress.
Wow.
Think of the analogy. It's like TSMC building a complex water-intensive chip plant in the middle of the Arizona desert.
A place defined by water scarcity.
Exactly. The land might be cheap up front, but the operational cost of pulling water from stressed local resources will only escalate. It turns a short-term advantage into a long-term disaster.
So you have a financial squeeze hitting Main Street, compounded by this physical squeeze on resources, which drives costs up for everyone. The cycle just tightens.
It does. Because money isn't infinite. While the hyperscalers have great credit ratings today, that doesn't last forever. When credit supply drops, the price of money, the interest rate, it just skyrockets for everyone else.
Okay, this brings us to the core paradox of this whole thing. This massive, debt-fueled AI buildout needs continuous, cheap capital to avoid collapsing.
Right.
And that brings us to Washington's upside-down world, where financial necessity is forcing the U.S. to look for cash in the one place they've been trying to exclude: China.
That's the crux of it. The U.S. is, in essence, over a barrel. Aggregate U.S. spending on AI now exceeds half of all investments being made across the entire U.S. economy.
Half of all investment.
The entire economy is betting on the success of AI, and that success hinges on stable, growing corporate revenue. To get that revenue and keep the debt cycle spinning, Washington is contemplating some dramatic policy reversals.
And we're hearing that the former president is weighing advanced Nvidia chip sales, specifically the H200 chip to China, reversing earlier national security concerns.
It's the ultimate trade-off. The need for immediate economic expansion, for keeping that fragile financial bubble alive, is now being prioritized over national security. The U.S. is essentially running back to China for trade after all the tariffing.
All because the AI build-out desperately needs the money?
It needs the capital injection from Chinese demand. This puts the U.S. in a classic double bind. Either choice seems to weaken the U.S. long term.
What are the two options here?
Okay, option one, sell the H200 chips. This guarantees immediate, massive revenue for Nvidia and AMD. It also keeps China somewhat reliant on the U.S. tech stack.
But the H200 is way more powerful.
8 times more powerful than the H20 variant that was previously approved. You are knowingly diluting your technological edge for immediate cash.
Okay, and what's option two? Ban the chips outright.
Man them. That cuts immediate revenue for U.S. companies, damaging the very build-out we've been analyzing, and it forces China to accelerate its own domestic innovation.
Which we've already seen them do.
We've seen it with Huawei's Ascent chips. The U.S. wins the short-term security battle, but loses the financial war while potentially guaranteeing a long-term technological rival.
So if the chips are sold, what's the likely outcome? What's the real risk?
The likely scenario is that China will stockpile a massive number of H200s and, at the same time, keep accelerating their own domestic chip advancement. You slow them down, but you don't stop them.
And the threat isn't just the hardware.
No, it's what they do with it. We have to talk about the Kim K2 model.
Right.
It is the fourth most powerful AI model globally today. And here's the crucial part. It was developed entirely within a Chinese ecosystem without access to the most powerful U.S. chips.
So they've already proven they can innovate on the software side.
Massively. If they get access to the raw power of the H200, they could potentially surpass U.S. models like ChatGPT very quickly. Imagine their software workarounds on top of brand new, high-powered hardware.
And that creates a new type of revenue squeeze for Silicon Valley.
Exactly. If China develops new, competitive AI solutions, they will fight for global market share and push global prices down. That's another downward pressure on the revenues that are so desperately needed to service that precarious $1.5 trillion in debt.
So how do you see it? Drop your thoughts in the comments. When we synthesize all this, the situation is incredibly precarious. The entire U.S. economy is banking on AI, and that success hinges on stable revenue, which is now being sought in Beijing. The U.S. is financially over a barrel.
It forces us to ask the ultimate question about this trade-off. If the U.S. is sacrificing its technological advantage in exchange for immediate money to support a build-out that already suffers from a 95% failure rate, what does this truly mean for the future of global competition? Could this desperate financial move today inadvertently guarantee that China builds a time machine, effectively accelerating their own leapfrog over the U.S. and the next generation of AI? That is the trade-off you need to be watching. And if you haven't subscribed yet, join GN9 so you don't miss the next insight.